Hi.
Good evening, everyone. Welcome to another Sunday Night Live. Welcome to Sunday Night Shotgun Live, I guess. I'm Clay, joined by the lovely and gracious and sweet and maybe a little sleepy E-Train. She she
Hi,
had
everybody.
had she had to get up early at about 6:30 or 7. So she's a little pooped.
Bed until super late. So yeah, I tried out because people came over. I was like, nap's not going to happen. Now I got to entertain. So yeah, life happens.
Life happens. Well, I hope it was fun.
Mm-hmm.
Hope it was a good day.
Mm-hmm.
It's been a pretty weekend here. Um, Summer's here. Sky's clear, beautiful. Temperature was nice today, so I got to spend it all indoors. But it was still a good day.
Aw, I'm sorry.
Mm.
If you are
Tonight,
watching on Rumble, hang on. If you're watching on Rumble, we're getting X's messages now, but not Rumble. So I've got the Rumble screen up. So if you guys have any questions, comments, anything, let me know. Or just pop them in there and I got it and I'll relay it to Clay.
and if you're on one of the others, feel free to throw out any questions, comments you have. Something doesn't make sense, let me know. A lot of times when I start, talking or carrying on or whatever, I may use some terms that are comfortable to me, but maybe not so much to you. So don't hesitate to let me know. Now, tonight we call it shotgun because it's kind of a scattered discussion. There's a lot of little different issues. We're going to take a look at some of the chaos in global markets. We're going to look at the plethora of political pandemonium that's going on in the world. We'll
There you
look
go.
at what I might describe as a steady stream of smoke screens in the economy, and all of that in one sitting. So tonight we're tackling a number of the biggest threats and opportunities flying under the radar. That I don't think or see or know of a lot of other discussion in terms of, other channels or the internet. So grab you a pen, pour you a scotch, prepare to challenge the narrative. Because by the end of the episode, you'll see how Japan, China, the Fed, AI, the election coming up, both in the US, Europe, might just be aiming at your portfolio.
Nice.
So don't hesitate to holler if you've got some questions. Excuse me. We're going to start off with what I call the global margin call. That might be the scariest phrase in finance.
I'm going to help you out there.
Thank you there. Don't know how I would have gone tonight. The scariest phrase in finance, margin call. Margin is when you borrow money to buy stocks or a security, also called leverage. And say you do it at 10 to 1. You borrow $10 for every $1 you put up. And then imagine with that purchase that stock prices start to fall. Well, for every dollar the price falls, instead of losing $1, you lose $10. So your losses are greatly magnified.
Yes, they are.
When you have an amount of cash that the broker uses as security, well, the losses are taken out against that cash. And once that cash starts dropping some, you'll get what is known as a margin call. Literally, your phone's ringing. It's the broker saying, your funds have dropped. You need to add more cash. or they'll have to close out the position, sell everything you've got, and you take the loss, whatever the loss is at that point. So you think that the price will reverse. You think this is just a short term anomaly. And so you add more cash to keep the position open. Well, stock price keeps dropping bit by bit, but it's a steady drop. It keeps falling, magnifying your losses at a rate of 10 to 1.
Yep.
Now, the pain starts adding up fast. And that's kind of the way some of this global finance with Japan, China, even the US is structured. And so I use margin as kind of an analogy. So let's start with Japan, the world's third largest economy. And right now, its financial structure is, to put it mildly, cracking. Not something I've seen a whole lot of other people talking about. Japan has been living on what I would describe as borrowed time, with its debt to GDP ratio at 250, 255%, somewhere around there. It is double the US's and it's triple China's. Now, don't know if you remember, but Greece had a debt crisis in 2010, and the Japanese position makes the Greek look like a amateur.
Mm-hmm.
Now, how many of you have heard that on the nightly news? It begins with the Bank of Japan, their central bank, their version of the Federal Reserve. And the BOJ has long been an outlier of sorts. An outlier in terms of central bank policies. Now, they had what they call yield curve control, which is the same as our Federal Reserve's QE. It's where they will take actions to lower the interest rates near zero. And they accumulate a fair amount of debt doing that. They print a lot of money.
And when he says QE, he means quantitative easing.
Yes. Think of it as the policy of giving banks free money. That's basically what it is in a nutshell. The idea is if they get money cheap enough, they can lend it out cheaper and stimulate the economy. Well, there's some other problems with that. Didn't quite work out that way, but what it does do is distort the price of money. It distorts the price of risk, and it makes money and financial assets extremely cheap. So a lot more money is directed into financial assets than, say, manufacturing or other types of investment. Because financial assets basically have a free return. They have zero cost, and whatever they invested in, that's just free money. That's one reason why the banks and financial institutions, greatly outperform most other sectors. Now, so they have their version of that. Theirs went even more extreme than the Federal Reserve's. They had negative interest rates on their short term. Negative interest rates.
How do you do that?
Which, a positive interest rate is where if you lend money to somebody or some institution, they pay you interest.
Right.
Negative interest rates is you lend money and you pay interest.
Who would do that?
There were some that did.
Okay.
Japan's an interesting country. So I won't go into all that, but let's just say that it happened.
Well, let me ask you this. I was listening to, it's sort of off topic, but really kind of not. Listening to, I know, you know me, I'm everywhere. Listen to Ron Johnson and Tucker Carlson talk about the U.S. and said, "Look, we're a wealthy country. The like we could pay it all off with people who can afford this kind of thing. Well, amount of debt or
You're
what we're
breaking up on me.
budget shit, budget amount of spending. We have enough people with enough money in this country that if they wanted to, they could help save the country financially."
No.
No? Okay.
N-
Help me.
No.
Okay.
They would have to sell assets.
Mhm.
Like Elon, on paper, he's worth
Right.
billions, but it's all on
Mhm.
paper. He doesn't have that cash sitting around somewhere.
Well,
So he
nobody
would
really
have to
does. Yeah.
sell. Huh?
Nobody really does. It's all
Nobody does.
invested in something. Yeah.
And so imagine all these people selling trillions of dollars. Let me look up something here. The stock market,
Mhm.
the entire stock market right now,
Mhm.
capitalization, the value of all the stocks is about $32 trillion.
Gotcha.
So everybody could sell every dime they have. Every stock would go to zero because nobody would be buying it,
Mhm.
and we still wouldn't have enough to pay off the debt. Now, you've got bonds, you've got some other assets, but just imagine that much in assets, real estate, bonds, stocks were being sold. The markets would be absolutely leveled. They would drop 70, 80, 90%. And so everybody's wealth would be destroyed.
Well, literally everyone. Yeah.
Literally everyone that had any amount of savings. The whole
Mhm.
economy would be destroyed. There would be no new investment. There'd be no jobs.
But wouldn't
Oh
that be
no,
like
no,
a
no.
reset?
It'd be like the apocalypse.
Okay.
Like a
A lot
nuclear
of
bomb had
social
landed in every
issues.
major city in the country. There were radioactive clouds everywhere. All production came to a halt. There's no money, no cash. You can't get anything out of your bank. Anything you have in your bank would be lost. Imagine
Really?
2008.
Yeah.
Multiply that by 10 times, 20 times.
Right.
It just would utterly it would utterly destroy the world's economy. So it
Okay.
bothers me that people will spread that kind of garbage or innuendo.
Mhm.
Um, when because most assets trade at the margins. That's
Mhm.
something a lot of people don't understand. Assets trade at the margin. Tesla.
Mhm.
I don't know how many people own Tesla, but let's say 5 million people do, maybe in their mutual fund or whatever, but a bunch of people own Tesla. Well,
Let's
they
say
hold it.
10 million to make it
It
make it
doesn't matter.
even.
Doesn't matter. They hold it.
Yeah.
They don't sell
Mhm.
it. You've got probably, I don't know how many trades a day, but you've got 10,000 people a day that trade it, buy it or sell it, not 10 million. So the activity of those 10,000 people determine the price. If more of them are
Mhm.
selling, the price drops. If
Right.
more of them are buying, the price goes up. simplified version here.
Okay.
But if all of a sudden you had 1 million of those people in the market selling, or you had all 10 million people selling, there's at most 10,000 buyers. So the price
Gotcha.
is getting hammered. Banks
But like,
would lose tons of money on their investments. They
this is
have to
probably
write that off against their capital, which would make them illiquid, and they would have to shut down their
gotcha.
branches, their ATMs, everything. Your credit cards would not work. Your ATM cards would not work. You might have $100,000 in the bank. Doesn't matter. You can't get to it. The bank shut down. You'll have
Okay,
to
let
wait
me
for the FDIC to bail it out. That might take 6 months. Not only that, the FDIC has, I don't know, $100 billion in assets. The total deposits will be 50 trillion. So how the hell do they bail out 50 trillion?
hang on. Hang on.
Yeah.
Just for those of us who don't know all the things about, you have a company, right? And you have income, you have losses, you have expenses, whatever, right? You're running your company. Excuse me. It becomes large enough that you can take it public, right?
Can't hear you.
It becomes large enough that you can take it public, said company that you started.
Okay.
Okay. When that happens, then there are stocks available for purchase, correct?
Yes.
You can buy stock in that company. So, how does that stock equate to the value of that company? The company is still making money, it's still doing its same old thing, right?
Right.
So, how is it that the stock relates to the actual company? Is that
Well,
making
it's the
any
same as
sense?
any other investment. Every investment is made in expectation of future return.
Okay,
Get how
but
you put money in now, how much do you think you're going to get out in the future? That determines how much you put in now or the price you pay for it.
okay. Why, okay, let's go back a step further. Why would a company go public?
Because several reasons. They need more capital. The original investors want to get their investment out of it. They want to
Which would
be
be
able to offer
the original owners or the original funders of
investors.
the. Okay, yeah.
Steve Jobs, Wozniak had an idea for a computer. It was going to revolutionize the way the world did business. They
Hmm.
went to a bank. Bank said no thanks. So they went to individuals. They got individuals to fund them while they were working in their garage trying to build the Apple computer.
Hmm.
Okay. Well, they get money. They start building some. They start selling it, shops there in San Francisco, um, Fernandina Valley, all that area. Then the company grows. Well, now instead of needing, a couple guys in this garage assembling the apples, they need a new building. They need to hire workers. They need to build an assembly line and equipment. They need secretaries. So they need more capital. Maybe
Okay.
the individuals will spring up more capital, but sooner or later they grow to a size where the individuals say, okay, I've invested $2-3 million. I own 50% of the company. I want a return. And so the company is big enough. It's kind of a small regional company. It's had a year or two of growth and production. It's got, growing reputation. So that's the time when it can take its company public because it's got a track record to show to investors where they can try to value how much they would be willing to pay for the stock.
Okay. So stockholders are quote unquote investors.
Yes.
Okay.
They just have a public ownership instead. Before the company is offered public stock, it's
Mm-hmm.
private ownership. And there's some rules regarding who can invest and how many you can have, that kind of thing.
Mm-hmm.
Once it goes public, you can sell as many shares as you want to the public. So you don't have those
Determined.
kind of caps or limits.
How was the price, especially when you first go public? How was the price of the stock determined?
Well, people will make an estimate of what they think the future earnings and growth of the company will be. If people believe it, think it's reasonable, they see the current stock price is a good value, they'll buy it. If they think the estimates are ridiculous, they won't. The price drops.
Okay, but who determines how many shares are for sale originally?
The company and the investment bank that's managing the offer. They put together a prospectus which contains all the information and key players, investors, projections, and they'll give it to the SEC. Well, the SEC reviews it for 90 days. During this 90 days, they take the bank. It'll be like Goldman Sachs, JP Morgan. It may be Bank of America, whoever is running the offering, takes it to some of their relationships, some of their clients who are mutual funds, pension funds, large investors, hands them a copy of the prospectus and say, would you be interested in this? And
Hmm.
those people look it over and they come back and they said, yeah, we might take a couple $1,000,000
But
at,
like a larger version of Shark Tank, let's say.
yeah, yeah,
Okay.
we'll take, $5 million at $10 a share. Somebody comes back and says, we'll take 10 million at $50 a share. So they get all this feedback. And then they kind of set the price and the number of shares based on what they think they can sell or raise, based on this feedback that they've received. And first day of sales, that's what it's pegged at. Normally, these IPOs, as they're called, initial public offerings, will see an increase of maybe 80% in the stock price on the first day. So it'll go from $10 a share to $18 a share by the end of the day. So they're normally pretty attractive to investors.
I'm just trying to get the basics in here so people know exactly how the process works.
That's
I know
fine.
with banks it's different, but or banks is not banks, but with like countries it's more bonds, selling bonds to cover their debt. But just so we have that understanding.
No problem. Um, so, Bank of Japan. Bank of Japan has been a little bit different in its in its approach to central banking. Obviously, they have run up debt hugely. Um, they also have a balance sheet that looks more like a stock fund. Most central banks don't buy stocks or securities. Um, their goal is monetary policy. I mean, their job is monetary policy. Well, Japan has taken this and felt like their job is really to micromanage the economy as a whole. So they've done a fair amount of weird stuff that has kind of set the pace for other central banks actually. But the BOJ owns 80% of all ETFs, exchange traded funds in Japan, or about 8% of the whole stock market, which is pretty pretty damn huge. And again, that's with borrowed money or margin. You know, people wonder, how does the government force the market to go up so everyone thinks all is well? Well, when free money no longer does it, the government simply goes out and buys it, buys the stock, greatly increasing demand. Hence, the price of the stocks go up. But in the past few months, something's changed. Some things have changed, I should say. Yields are rising. The yen is falling. Currently, today, it was at 144. It has gotten up to 160. The carry trade, which is where global investors borrow in yen to invest in higher yielding assets, is at risk. We can see where the money is beginning to flow out of Japan. That's a big deal. Investors are fleeing Japan. Now, it's a huge dash for the exits from Japan. Last week, we saw the biggest weekly outflow in history. More than $11 billion were peeled away from Japan's markets. Their equity funds experienced record-breaking withdrawals during the the last week of May. The government had a very underwhelming bond auction. So the government had trouble selling all of their bonds. To be honest, Japan is not alone. Europe has started seeing large outflows. For example, France just announced new tax hikes. Italy is raising capital gains from 26 to 42%. UK got rid of their non-dom rules, essentially destroying tax incentives. And across the rest of Europe, it's just plain